Okay, good morning, everyone. I'm Devin Ryan with JMP Securities. Really pleased to have everyone here at our annual financial services conference. So hopefully everyone has a good schedule and has a great day. Really looking forward to kicking off the day here with Don McCree, who's Vice Chairman and Head of Commercial Banking here at Citizens. And just to start, I would say, yesterday was the 2-year anniversary of being part of Citizens. And so
you're still not saying JMP, a Citizens company?
We're part of the Citizens family, and it's really been, for my seat, in research, it's been a great story so far, and I think there's still so much more to do together. So with that, I think we're going to cover a lot of ground here in this conversation. Don, you joined Chemical Bank, the predecessor of JP Morgan Chase, in 1983. Spent over 30 years at JP Morgan, played, I think, an integral part of what JP Morgan is today, kind of the force that it is in the market. So maybe tell us a little bit about that journey that you had there, and then what brought you to the current role here at Citizens, and really what excited you about coming to Citizens.
Yeah, I won't spend a ton of time on the JP days. I did a whole bunch of different roles there. We started as kind of a troubled, large bank at the time, Chemical Bank, and you remember back in the 80s, a lot of the big money centers merged together and created these big colossus which exist today. But I think the theme of my JP Morgan time was turnarounds and acquisitions. So that's a little bit the same theme of Citizens. So I retired in 2015 from JP Morgan, and I was off to do private equity or do a credit hedge fund. And I ran into Bruce Fonson, who's our CEO, and we were about to take Citizens public. We were the largest financial services IPO in history when we did it in 2015. Citizens was part of Royal Bank of Scotland, which was seized by the British government during the Great Financial Crisis. We operated Citizens for basically 8 years in a bankrupt state, trying to withdraw from the United States, either sell the company or eventually IPO the company. And when I first spoke to Bruce, I said, I really do not want to go back into banking. I've done 30 years in banking. I've had just about enough of it. But when I heard the story and I saw the capital levels and I saw the liquidity levels and I saw the state of the company, it got very exciting. And my view was I could take a traditional banking role and take an entrepreneurial approach to build the company, and that's what we've been trying to do for the last 8 years. And it's been a lot of fun. We've hired a lot of people, done a lot of acquisitions, and it's been better than I ever thought it was going to be when I joined. So I look back and I'm really glad that I made the switch.
Yeah, that's great. Well, I guess maybe the last 12 months have been a little bit of a different market backdrop. So I want to maybe start there and just let's talk about what you've seen over the last 12 months. We obviously had a crisis of confidence in the regional banking sector early in the year. Regulators have effectively vowed to impose new rules on the industry, and markets are now grappling with higher rates and obviously the geopolitical uncertainty that's out there. So I guess what's your perspective right now on the state of regional banking today, and what else do you think needs to be done, if anything, to restore confidence in banks?
Well, I'm glad you went back 12 months and not 9 months, because it really did start 12 months ago. And what I've observed to a lot of groups is it's not really where rates are; it's the violence of the moves. And I've never seen anything like this in my career in terms of, and it started by, unfortunately, hurting a lot of the things that JMP does in terms of the collapse of the tech sector, and a total rewrite of the venture capital industry. And then comes these two, and they went to great lengths to not call themselves regional banks. They were something different. So we call them the idiosyncratic failures, because we think the regional bank sector is quite different. But that being said, the speed with which money ran out of those banks, and the confluence of social media and online banking and digital banking kind of shocked everybody. I mean, $40 billion in a day with another $40 billion queued up to go out. The regulators are going to respond to it. It was a hairy week. I was actually on a ski lift when Silicon Valley was going down, and there was a venture capitalist next to me tapping his phone. I said, "What are you doing?" He said, "I'm transferring all my money out of the regional banks." And I'm like, "Don't do that." But it stabilized pretty quickly for us. I mean, what we saw was a knee-jerk reaction to anything not money center, potentially risky. So a lot of money flowed out of the money center. We saw a lot of large corporates diversifying. So if you had 100 million with one bank, you put 33 million with 3 banks. But within about a week, things started to calm down. We had actually, thanks to my old employer, JP Morgan, a guy named Mike Sembles put out a research piece which basically ranked all the regional banks and mark-to-market securities portfolio, and we were second in the entire peer group. And that we used with clients to calm them down. We told them about our liquidity position, which is about the strongest in the peer group, and we've got 70% insured or insured deposits and about a little under 70% retail deposits. We've got a super diversified deposit base, but there was that week where nobody really wanted to listen, and everybody was just kind of making moves. But as we told our story to particularly our good clients, they began to move money back that they had taken out, and we actually got quite a bit of inflow from First Republic clients and SVB clients. We didn't take them all because we only want to take deposits from companies that we want to bank. So we were pretty deliberate on what we brought on. So fast forward to today, and I think the regional bank sector is pretty stable. I think everybody's making adjustments to their balance sheets and to their business models. A lot of it is a result of the changes in regulation that are coming and haven't come, and those will be capital, there'll be balance sheet construct in terms of long-term debt issuance, and there'll be liquidity. I think the new liquidity rules aren't written yet, but we would expect that they would have much larger outflows for non-operating deposits, so we're adjusting our deposit mix, and we're almost done with that. So we try to get ahead of these things. And I was with all of my peers about a week and a half ago at all the other banks, and everybody's basically running the same playbook. We've done a couple other things specifically at Citizens, which is we're moving out of businesses which are not deep client businesses. So in the second quarter, we announced the sale of a $9 billion auto portfolio. And we've securitized some of that already, but you'll see us do more of that in areas where we don't have broad relationships, and we think we can redeploy the assets in a more attractive way.
Mm-hmm. So you just hit on a little bit of this, but despite the turmoil and this kind of volatile period, Citizens has managed to survive and actually thrive in certain areas. And you didn't mention, but we added 150 new colleagues from First Republic to launch the Citizens Private Bank recently. So maybe just talk a bit about that, and also how the bank has differentiated itself. You gave a couple examples, but other ways that banks really differentiated itself, and what have been the keys to the success?
Well, it's interesting because what we said to the street in the second quarter is think about what we're trying to do as a company in 2 ways. One is we're adjusting our business mix to reflect the new regulatory realities. So that feels a little negative in terms of you don't want to go into a cave and just do that. But then we said we're going to continue to be on the move in terms of growing strategic areas of our business. The biggest one is the private bank. We've made, we've been trying to grow a private wealth business aggressively for the last 8 years. We bought a company 4 or 5 years ago called Clarfeld, which is a big family office business up in Terrytown. We got to know a number of the senior private bankers at First Republic, and when they were sold to JP Morgan, our phones started to ring, and they said, listen, we're not sure what we can do, that we can do what we do at JP Morgan, not because there's anything wrong with JP Morgan, but they're just huge. And if you remember First Republic, what they were is a service company. All they did was really provide excellent service, and we began to dialogue with the bankers and talk about, how can we deliver that service bundle to their clients on a platform like Citizens. 150 of them ended up joining us in Silicon Valley, in New York, in Boston, and in Palm Beach. And then about another 200 we brought on in terms of additional support for those bankers. And it's quite, they're extremely strong in terms of banking skills. Their clients are extremely loyal. Maybe some of you are First Republic clients, but the clients are already beginning to move onto our platform. So that's been really exciting in terms of a growth area. The other growth area that we're focused on is a little bit quiet right now, but we've been putting a lot of chips on private equity and private capital. We have a very big private equity, private capital business, and we think that's going to be one of the main drivers of business for our combined company as we go through the next several years.
Yeah. So obviously, private bank acquired JMP, some of these strategic moves. How are they maybe additive to how Citizens goes to market today versus even a few years ago, now being a part of the team,
Well,
like the capabilities?
if you think about, when I joined, we were basically a bog standard commercial bank. We made loans and we did payments, and that's kind of all we did. And within about a month and a half, I started seeing our clients sell themselves, and I saw them being sold by Goldman Sachs and JP Morgan. Yep. And I said, that's a 50-year client. We're not going to let that happen anymore. So we started to build up the investment bank, and we built up leverage lending first. Then we added high yield bonds, we added high grade bonds, we added ABS, we added hedging capabilities, commodities, currencies, and interest rates. And then we started buying M&A boutiques. And we've done 6 acquisitions in the last 5 years. Most of them have been industry-themed acquisitions because we believe industry differentiation is the way to really win business, particularly with the PE firms. And JMP, as you said, 2 years ago, brought us the equity platforms in addition to tech, biotech, financial services, which we really didn't have a lot of prior to that. Unfortunately, as my boss tells me, we bought at the peak because we bought at the end of 21. You guys had a record year. Congratulations.
We'll be back.
And we've been a little slow, but it's coming back, which is good. But our whole business strategy is to have every capability that we need to serve our clients through good and bad times. Yep. And we never want to be saying to a client, you should execute in this way because that's the product we have. So we try to give options. We distribute most of the risk that we originate on all pieces of our business. And then, if you think about the addition of the private bank, it brings that last piece, which is wealth management and a much broader group of clients. And it's most poignant, actually, in San Francisco and Silicon Valley. So Mark Lehman, who's here as part of this, we just named him the head of California to bring together JMP, Citizens, and our private banking efforts. And we see, if you just think about in the Valley, if you think about a private banker banking a venture capital firm and the principles of a venture capital firm and doing some early stage debt, a little bit of early stage debt, and those early stage companies mature and go through A and B rounds, and then all of a sudden they go public. Those are natural clients for JMP, and we're already beginning to see those synergies. So we see a continuum there that's quite attractive and quite exciting for us.
Yeah. Well, I would say 21 was a record year. Having a couple slow years isn't the worst thing when you're integrating businesses together because the firm wouldn't have been able to integrate the same way it has been, I think, over the last 2 years. And so that's kind of the perverse part of it.
And I think that's important, Devin, because you see a lot of acquisitions in particularly regional banks, but even in the big banks, which tend to sit outside of the core company and almost operate as independent companies. I've always had the attitude that you've got to totally integrate, and I would say 50% of the business that we're doing with our acquired companies have come from our franchise that we would not have done if we hadn't bought the companies. The other 50% comes from clients that you all bring or that the other M&A boutiques bring.
Yeah, it's great. So when you think about the evolution of the commercial bank from here, are there other areas of strategic priority or other ancillary services that you expect to expand in from here? And obviously you mentioned you've overseen 6 acquisitions. Do you feel like we now have all the pieces in place, or I guess what's next in terms of strategic?
I think we have all of the pieces. We're missing a couple important industries like healthcare. So 20% of the economy, we're not as big as we'd like to be in healthcare, and we're missing some scale. So we want to get bigger in the industries that we're following. We want to get bigger in some of the product groups that we've established. We want to move. We're leading much more than we used to lead in terms we used to participate in deals, and we're beginning to lead much more. So we want to continue that continuum. And then the one thing I haven't mentioned is we're spending a lot of money in our payments business. We had to rebuild that from scratch about 7 years ago. It's actually growing faster than the industry right now. But we think it can grow much faster. So areas like embedded finance and buy now, pay later and all of that, which we're doing a little bit in, we want to really double down and begin to grow the payments business in the low double digits probably.
Mm-hmm. And in terms of organic versus inorganic, are there acquisitions that make sense to do, or do you think the pieces are there to really scale off of?
Whenever we grow, we look at both. We look at inorganic, or we're doing a lot around stakes right now. So taking stakes in emerging companies that, particularly on the technology side and probably on the payment side, where we actually believe that they have a differentiated technology or a differentiated service, and we can influence the outcome as they grow. It's hard because, you know, where are you in the capital stack, and can you really have that influence is the question we think through, but I think you'll see us do a little bit of that too.
Yeah, great. You touched on sponsors. Sponsors are such a important part of kind of the capital markets ecosystem, but really in finance today, you know, they're virtually everywhere. And so tell us a little bit about the growth of the sponsor business within Citizens, all the areas that we're connecting with sponsors, and really how these relationships have helped accelerate the bank's growth.
So we have, I break it into three pieces. We have about probably 450 sponsors and venture capital firms when you combine in the private bank that we will cover or we will bank or try to bank. We have about 60 core sponsors in the commercial bank, which tend to be, and when I say we bank them, we're really banking them for middle market activity. So what we've tried to build is a middle market investment bank. So we're not going after the $10 billion deal, we're going after the $250 to $1 billion transaction. And we think that that's a power alley. Actually, in leverage finance, I haven't seen the third quarter tables yet, but we were number 2 in the second quarter, number 1 in the first quarter in terms of sponsor finance of middle market buyouts, and we actually gained quite a bit of share. We were quite busy. So what we try to do is it really takes a series of flavor. We're going to bank the complex. So we do a lot of subscription lines. We do fund credit lines. We will do partner loans out of the private bank. We'll do some management company loans. So banking the GP and the LP. Then we have a big M&A flow. So I've got about 4,000 middle market companies that I bank, and about 10% of them every year want to do a transaction. Usually, you know, kids don't want to be in the family business after watching the Great Recession and COVID and everything that their parents had to deal with, so they want to be sellers. Yep. So that's an M&A flow that is almost proprietary to us because these are 10, 20, 30-year clients, so that's valuable to the private equity shop. Then we'll do the financing on whatever buyout that the private equity shop is doing, and then increasingly we're capturing the proceeds of the transaction into our wealth business. So it creates kind of and importantly, because we're financing the buyout shop, the company doesn't attrite out of the portfolio, and we keep all the goodies in terms of payments and deposits and everything that is core to a commercial banking relationship. And then hopefully when the PE firm triples the size of it and sells it 5 years from now, we'll be on the sell side with the PE firm. So it's a flywheel that, if we can get going, is very attractive. We're also selectively putting some equity investments down with some of our better private equity firms in terms of some investments in some of the other pieces of their business. It's very small right now, but it's another way that we think we can kind of create a bond and create a value that's different than some of the other people. And then we're talking to a few of them about how do we play private credit. You know, private credit, I know some people here are probably in private credit. It's just a massive growth engine at both the large AUM PE firms, but also independent firms. So we're figuring out a way that we want to participate in the private credit markets.
Yeah, that's great. Sounds like made a lot of progress, still a lot of opportunity ahead there.
We'd like the markets to come back a little bit.
Well,
it's been kind of tough to deal make right now.
I know. Well, we'll get there. So I guess that's a good transition here just to talk about the capital markets and the environment we've been in. Really 2 years of a downturn. You know, I've done this for 20 years, and these are 2 of the hardest years that I've seen in this business. And what we do know, though, is inevitably it will come back, and we want to be positioned for that. And so love to just maybe talk a little bit about what you're hearing from clients, you know, kind of where they are in decision-making processes, and then, you know, kind of what the catalysts are going to be to drive them to actually transact again.
I kind of like this week.
Yeah.
It's been pretty good.
Yeah.
But I'm not declaring victory yet.
Yeah.
I think people are a little bit premature. But so I mean, there's a couple different things. You know, one is it's very hard to do a leveraged transaction right now. So go to the core buyout. Then I'll talk about the corporate clients in a second. But go to the buyout business. You've got a dislocation of valuation between buyer and seller. And then you've got a cost of funds, which kind of creates the inability to leverage the way that you were able to leverage 2 years or even a year ago, just because of the carry out on the interest bill. So that's created a lot of sand in the wheels. Again, one of the interesting things that we've seen is because of the sector of the market that we're in, which is the mid-sized company, there's been more deals kind of happening because the sellers in some ways just kind of want out, and they're willing to compromise value a little bit. And we're doing a lot of creativity around partial sales and stubs and investments into companies, which has been interesting. If you go to regular way corporates and commercial real estate, they're kind of hesitant to move into the capital markets in size, or they were when they thought rates were going to be going up. When there was such volatility in the market, they were very scared about stepping into the markets because they didn't know what the markets were going to do in any given day. It's gotten super active in the last 3 days as the 10 years come down to 4.5%. And what we said to people is, again, 4.5%, it could be 5.5%, a year from now. And there's been a little bit of a waiting game where a lot of people were hoping that rates were to come back down, so they didn't want to move into the markets and lock in the higher rates. So there's a little bit of movement right now, both on the convert side and the high yield side and on the high grade side, actually. The advice that we've given to clients is just get ready, because there'll be these windows that open and close. So, but the other thing that's happened is back to the regional banks and even the large banks and the regulation and the liquidity and the restructuring of balance sheets. There's been a withdrawal of bank credit, kind of generally across. So if you look at the H8 figures and things like that, it's been relatively quiet. The private credit guys have filled that void a little bit. But what we have said to our investors and to our board is it's as much demand as it is supply. So when I am out with corporate clients and when I'm out with small business and medium-sized business, they really don't want to lever. So they're not out borrowing. They're not building new plants. Their working capital is shrinking. The inflation pressure on working capital is going down. So we're seeing the industry loan balances kind of go like this. So if you get deal making back, that's going to be the catalyst for a lot of activity in capital markets and a lot of activity in the bank markets. The other thing is there's massive amounts of money that have been raised for distressed situations. Not a lot of it has been deployed yet. There's not a lot of liquidity in those distressed markets yet because things aren't that bad. I mean, even in commercial real estate, we have a big commercial real estate business, and it's kind of, we're working through it. And so, Armageddon, which a lot of people were kind of worried about in inflated asset classes, tech, real estate is manageable so far. And the C&I side, and my theory on this is that a lot of our C&I clients fixed their companies when they went through COVID. So they delevered, they cut costs, they cut inventory, they got more efficient, and so they're entering whatever we're going to enter, whether it be no recession, light recession, or large recession, in much better shape, having gone through that experience. And that's what we're seeing play out. So what I hear from most of the corporates is, I'm doing fine. I've got a little bit of margin pressure now. I've got a little bit of margin pressure plus interest coverage pressure, but I could be doing better if I could get labor or if I could fully restock my supply chain and the like. So C&I seems fine, and real estate seems manageable. So I think that the chances that we're going to really have a massive recession seem to be going down, although some of the earnings have been a little bumpy and some of the guidance has been a little bumpy, but I think we're going to get through this in a reasonable way. And if people get the confidence that rates are going to drift or stay in the 4.5 range, and get the confidence that we're not going to have a big recession, I think we're setting up for a pretty good year next year, broadly in the capital markets businesses.
Sometimes just time goes by, and it takes that time to kind of bring the bid-ask spread together. Right?
And it's the bid-ask spread, and there's maturities coming.
Yeah.
So we haven't had a big. Everybody pushed out when rates were low, but when you get into 26, 27, 28, you begin to have a maturity wall that is going to force people to go. So that's why we're saying get ready now, and if you see a market window, go and hit it.
Yeah, I mean, if you're the CEO of a company and you're CEO for maybe 7 years, your tenure, and we're now 2 years into doing nothing, it's at some point you have to move on with your strategic plan, and so there has to be maybe some compromise. And so is that, when you're in the front end of the rate tightening cycle, and to your point, it was violent, but now I think this consensus is tightening around what the next year is going to be, even if it's slightly higher or slightly lower. It's not a rate of change that's been anything close to what it was 2 years ago when it started. So is that kind of the sentiment from corporates that maybe we should, even if it's not the perfect price, maybe try to sell this asset, or we're not going to get the perfect price buying?
I'd say a couple. Yes, absolutely. And you're younger than I am, because I remember when my mortgage was 14%. So rates aren't that high.
Yeah, right.
So yes, you got to get some stability, and then you'll see valuations begin to adjust. The other thing that I think is and it's certainly an issue in the banking industry, but it's an issue broadly, is the government, right? And the thing that I hear from CEOs a lot is, if I'm going to do any kind of scale deal, I'm really worried about Washington and getting approvals. And do I want to step out and waste the time, waste the money, probably go to court in a lot of ways, and that's definitely part of the calculus right now. So you've got to get the valuations you got interest rates stable, you got to get valuations closer together, and then you've got to get the government approval risk out of the equation, particularly for a big company. The PE guys don't really care about it. The smaller mid-market private companies don't really care about it, but a big public company cares about it a lot.
Yeah, absolutely. So good transition in kind of the year ahead. So you talked a little bit about kind of capital markets environment. You also do have an election coming here, but my view is it's either kind of status quo or probably something friendlier. So you're probably debating between that, but maybe that's not a worse environment. So how do you think about just the year ahead in terms of, you mentioned more activity in 2024. I guess what businesses, what verticals feel best positioned heading into next year?
Hopefully, tech, financial services, and biotech.
Yeah, I would agree.
I don't. I think the only place that we're concerned that there might not be a decent amount of activity is consumer-linked areas, depending what the consumer does. So we're watching Christmas and the holidays quite aggressively to see how does that roll through retail, how does that roll through anything linked to the consumer. And then I think you'll just see, I think general industrial will be very good. I think gaming, which is a big part of our business, will be quiet except the online gaming piece. Healthcare should be active, but not in the hospital space or not in the skilled nursing space, but in the general healthcare, it should be pretty active. And I think financial services is going to be active. And I think you're going to start to see, the new company formations in venture and a beginning. There's a lot of biotech and a lot of venture companies that are going to need to raise capital. So I think we're pretty optimistic about that.
Yeah, and with maturity walls coming, 2020. Later 24, 25, 26, how do you think that plays out? A lot of distressed capital has been raised, but potentially non-event, I guess. It depends on where rates go, but how do you feel like that?
I think people will start to come to market. I think, again, it's a troublesome world out there, obviously. There's such geopolitical risk that even, if the U.S. interest rate cycle has calmed down, you can wake up any day and there could be just something that could close the capital market. So if you're a CFO or a CEO staring at a maturity 18 months from now, that's going to start to get more and more uncomfortable just due to things outside of your control. So I think those are going to begin to be refinanced. It could be, they could be refinanced on banks' balance sheet or private credit balance sheets and not go into the capital markets and not lock in, but lock in with swaps and things like that, and just wait out to see if interest rates actually do come down farther. Yeah. We kind of think that four-ish is about the right level for the 10-year over the next few years, maybe a little bit less than that, but that's kind of what we're planning against. And so we're not going to be that far from that. And the penalty of, we were a couple of weeks ago, 5.25, maybe, I guess we sort of topped out. That's hard. So I think you'll see people addressing their capital structures in addition to transacting, which should make for a pretty good 24 in my mind.
Yeah, Great. To close out here, maybe want to zoom out a little further and think strategically kind of about the future and perhaps maybe the next 5 years. And just great to get perspective around what's getting you most excited about the future of the business, how Citizens can continue to transform itself into both on the commercial bank side, but also even on the consumer bank side, and really to get ahead of customers' needs and priorities and how we're positioning for that.
Yeah, so I think just broadly, we are manic about customer service, and we've been doing a lot across the company in order to really broaden our relationships and deepen our relationships on both the commercial side and the consumer side. So it was most extreme on the consumer side, where we basically had product companies. So we had an auto company, a credit card company, a mortgage company, and we had very little shared clientele across those. And we've begun to move down the road of really bringing those client sets together. So that's quite exciting. We were the leader in some of the innovation around buy now, pay later. So I don't know if people know, we basically invented the iPhone buy now, pay later program with Apple. And we finance every iPhone sale in the Apple stores across the country, and have been doing that for the last 4 years. Mm-hmm. And we've translated in that to like Trek bicycles and alarm companies and a whole bunch of different things. So we've been quite innovative on the consumer side in terms of creating bundles of services and bundles of products that are quite attractive to the customer base. The private bank allows us to move into the higher affluent, wealthy set of clients that we have not really banked before. So that's de novo for us. We've done a little bit in Clarfeld, but it's going to be multiples of what it was. And then if you move on to my side of the business, I just think that we're going to come out of this trough that we've been in, really reinforced around the relationship value that we bring to clients. And we're relatively small. We're $220 billion. So we put a premium on customer service and differentiation around customer service. So, the interesting thing, the first thing that cemented the franchise was COVID, because we were able to do, I can't remember the number, Chris, 40,000 PPP loans in 3 weeks. Mm-hmm. And we did it by building API technology with the Small Business Administration. And when I go around to clients, what I hear is, you saved my company. We're never going to move our relationship away from you guys. And you didn't save it because you gave me a PPP loan. You saved it because you gave me tough love and told me that we better get our act together and crank down those costs. So I think times like this, where things are uncertain and rough and people are kind of having to make tough choices, if our bankers are doing their right job and our product and advisory experts are doing their right job, this should be a consolidation time for us, and we should come out of this with even stronger relationships, which will allow us to take that entire service suite and deliver it back into the clients. So I'm pretty excited about the future. I think there's a 50% probability that you'll see the regional banking sector consolidate sometime over the next 5 years, and that'll be to get scale in technology. Mm-hmm. And get scale in regulatory management more than anything else. Mm-hmm. But whether that happens or not, there's so many variables that go into that. We'll see interest rates have to kind of come down a little bit to allow that to happen. But I think you'll see some interesting things happen around the regional banking space.
All right.
Whether we participate in that?
To be continued, yeah. That'll be obviously exciting to follow. So first off, Don, thanks for doing this. Pleasure spending time with you, and thanks everyone for joining. So
and thanks everybody. If you're a client of ours or we're doing business together, just thank you for the trust in us and the willingness to sit down and talk about what the challenges are and what the opportunities are. And if you're not, you should come join us. It's pretty good.
Absolutely. Terrific.
Right.
Thanks everyone.
Thank you.
Thank you.